Hello, Arianna. Thank you
Hello.
for joining me today. Thank you for agreeing to record one video in our series of podcasts that we've started in the FinTech Horizon 2020 project. Thank you for being part of the team from the beginning of the project. Also, before for when we were working on the proposals, you were one of the core members of the team. And I would start with the main developments, the main directions connected with our project with technology and finance. As everybody is aware, the artificial intelligence and the blockchain are entering more and more into the financial sector, fueling innovation and developments. So new products and services are emerging. So how do you see the impact of this new technologies on the financial credit risk in particular, and on the management of these risks in general?
First of all, thank you, Vasile, for this opportunity. Let's start with saying that in the last decade, the spread of the financial technologies supported the rise of digital lending. That is, new ways to ask for and giving loans, supported by digital technologies. A typical example is that of credit online platforms called the peer-to-peer lending platforms, where private individuals or small companies can directly ask for loans that are provided by other individuals or companies that wants to invest their money. Thus, these platforms allow for a direct connection between borrowers and lenders. And this direct connection takes both opportunities and the new risks. Talking about opportunities, we can mention an easier and more rapid access to credit, and also reduction of the costs with respect to the traditional system. But we also have a new potential channels for credit contagion, with an impact of financial stability and systemic risk that obviously concern the regulators. And talking about credit risk assessment, also here we have both advantages and disadvantages with respect to the traditional banking system. The disadvantage is that these platforms usually do not have the availability of credit and financial history data that, for example, a bank can have about its customers. But from the other side, these digital lending platforms involve their users in a kind of social network activity that generate a lot of data, and this data can be used to improve the measurement of credit risk.
Thank you, Arianna. And I know you have worked and are still working on using the network approach to the assessment of the credit risk. So please give us more details on how does this work. So basically, who can benefit from using this network approach to assessing the credit risk?
Yes, using very simple words, the network modeling approach is a statistical technique that allows to represent a relationship drawn as edges in the network between the nodes that are individuals, companies, or financial institutions. And analyzing the links between companies and thus between borrowers allows to better define the position of a borrower in its industry or market, and so improve the prediction of the default event for that particular company. This is surely useful in a context where there is, as I mentioned, lack of traditional data about a borrower, and so studying its relationship can have a very high impact in improving predictive accuracy. And this does not only concern the new financial digital operators, but also traditional lenders, where, for example, for new customers, there is the need to assess the position of the borrower because the historical information is scarce or low quality.
Okay, thank you for this information. And based on this topic, I know you've co-authored a use case for the FinTech Horizon 2020 project. So I would kindly ask you to give us more details about it. So touch upon the main idea. What are the main methodological steps that you have followed? What are the main findings? And also, finally, if you can elaborate a little bit on the innovation part and what would be the practical use of your findings, of the research findings for regulators, supervisors, fintechs, banks in general, so for the system, financial system in general.
Sure. There are many potential network models depending not only on the statistical technique that you use to estimate the model, but also depending on the data that you use to define the relationships between borrowers. In this case, the idea was to consider business relationships between companies. That is, in this network, used in this research work that you mentioned, two companies are connected if they have commercial relationships one with the other, and the presence and the strength of these relationships are estimated using trade flows at the sector level. The idea is to include a component that consider the business-based network and include this component into a credit risk model. From a methodological point of view, we used a spatial logistic regression model where the additional component, the spatial one, is precisely the network. And the network enters through a connectivity matrix where each entry represents a weighted link between two companies based on their commercial relationships. We have seen that including this network component into a logistic model does improve predictive accuracy, and it does especially when there is lack of traditional financial and liquidity information about the borrower. So I think that this kind of model can be of interest for both fintech that need to measure credit risk for the financial services that they provide, but also for more traditional operators.
Okay, so starting with this, what's next for you, Arianna? So where is your future research heading to? And also, what do you think are the main developments in this merger between finance and technology, let's say for the next year?
Well, this work, such as other research works developed in the FinTech Horizon 2020 program, are innovative from a methodological point of view, but still use quite traditional data, such as trade flows data. So I think that the real challenge for future research is to apply the network approach to new alternative data, such as data coming from social networks, or for example, actual transaction data, so not estimated at the sector level between companies. And I think that the merger between finance and technologies that is going on will provide this new source of data, and thus will be helpful in improve predictive accuracy of the new credit risk models.
Thank you very much, Arianna, for your time and for sharing this information and these insights with us. And I'm very happy that we're together part of this project. And I'm definitely convinced that this research will fuel future innovation, exactly as you said, when better data will be available. So thank you very much.
Thank you, Vasile, and bye, everyone.